Next, we're going to move on and talk about some of the market commentary around the bond market and translate some of the jargon. I suppose one of the things that we've heard a lot about in the media and market commentary around the bond market is this idea of yield curves and the changes in long-term yields. Obviously, the 10-year bond, government bonds, are very closely tracked. Could you just explain what people are talking about when they're referring to the yield curve and how it affects bond market investments?
Yeah, very simply, a yield curve is an expression of how much interest rate you can get depending on how long you're prepared to extend your loan for. So if I lend money to the UK government at this moment in time for 1 year, I will get an interest rate of around 0.5%. Alternatively, if I lend the money to the UK government for 10 years, I get an interest rate at this moment in time of just under 2% year on year. So, and if you were to plot all of those different maturities on a chart and join up all of the dots, that curve that you would trace out would be called a yield curve. So it's an indication of how much yield you get for different terms of loans to that organisation, in this case the UK government, but you would get yield curves for corporate issuers as well.
Absolutely. So you'd have a yield curve, for example, on government bonds, and you'd have them on a generic set of corporate bonds as well, for example.
If you have a regular corporate issuer into the marketplace, that individual issuer will have its own yield curve. Okay. But what we tend to do is when we look at yield curves for corporate markets is you will interpolate, you will do a scatter plot of all the different bonds at all the different maturities, and then you interpolate the curve from there, and that gives you a corporate yield curve as well. But there'll be errors around that corporate yield curve.
I suppose alongside that idea of yield curve is where interest rate expectations comes from, which sometimes we hear talked about. In a period where interest rates are supposed to be or in the process of perhaps being increased, or when central bankers are considering increasing an interest rate, people often talk about it in the lead up to it, that as an event itself, it may have some effect on the market. But is that necessarily the case if the market already expects that move?
Exactly, no, it's probably not. You're probably in the short end, if we see a very modest rise, which was only what we can expect, maybe 0.5% tops, even as possibly 0.25% in the United Kingdom. You might see a bit of fluctuation around the 2 to 3 years. So if you lend money to the British government 2 to 3 years, you might see some volatility there, and particularly in government curves, whereas Darren's previously said that's where they're concerned about rates rather than credit. But at the longer end, i.e. more than 20 years, actually that part of the curve is relatively flat, and there's probably arguably some good value there. So a lot of it's probably priced in already. We've been talking about it now for about 2 or 3 years as something that's going to happen soon. And we might carry on talking about it for a little bit longer. It's very data dependent at the moment. The Fed will probably start either September, or if I don't think they'll do anything over the winter months, maybe March. And then the Bank of England will look at what they're doing. But that's probably yet another year's past with no real interest rate risk. But the market's constantly pricing in a rise in rising rates and discounting those bond flows.
But this thing about the yield curve, I mean, you might have the impact. So generally people think interest rates going up, that's bad for bond price because bond prices go down. You could have it that if bond investors feel that a central bank's getting ahead of the curve and it starts to put up interest rates because it's worried about future inflation, and future inflation is the thing that ekes away at the returns from bonds because you have a fixed rate return. If you put up short-term interest rates, investors might say, well, actually what they're doing, they're quelling long-term inflation. So short-term interest rates go up, but actually your long-term interest rates on bond yields fall because people say, well, they're really doing something about inflation here, they're being serious. So that's why as bond investors, we try and forecast what we think is going to happen to the yield curve. And it doesn't move in straight lines, it can often change shape. And that's something we've been very much watching over the last few years.
Yeah, I mean, that's a great point. I suppose what you can have different shapes of yield curve. You can have a steepening of a yield curve, for example, or you can have an inversion, which you were talking about there, where the long end goes below the short end. Could you just kind of explain those in more detail, maybe some of the macroeconomic causes of those?
Yeah, I mean, I think we've been talking about, we were saying earlier, is the fact that people are expecting rates to rise either in the US, and the US Treasury curve has a massive gravitational pull and will have an effect on the UK and the rest of the world. And I think this is one of the Fed's problems. I'm starting this question quite slowly because it's quite difficult to explain. And the problem you have is that, in 2014, I think a lot of people were caught out. We're expecting the market to be moving something along the lines it is this year. And I think most people did really well out of having long duration gilts or government bonds or bonds in general, which meant they had a really good performance in terms of total returns. This year, it's been a bit more patchy. I think rates had a bit of a torrid time in the first quarter or so, and then have now basically recovered some poise on the back of the recent turmoil around the global economic markets. But what we're looking at is, as far as it's been in the last 2 or 3 months, is that yes, we've always had a positive yield curve, as you say quite rightly, and it's people expected it to steepen. It did at the beginning of the year, but now what's happened is the curve has flattened as the lower interest rates rise faster than the long end. And then just recently, following the Chinese devaluation of their currency, the long end has basically come down even lower to what we call a bull flattening, which means that the end of the curve has dropped down. So it's convoluted, but at the end of the day, I think people are still expecting the rate rises to come this year at some point. It's not as easy as it was before. It won't be just big rises and a general constant every meeting, 25 basis points or 50 basis points. It'll be a long drawn out affair, and I think both the Fed and the Bank of England are very, very aware that they have to make sure that they forecast these rises properly, which is why we've had some hesitancy recently on the basis that the data hasn't been particularly awe-inspiring on both sides of the Atlantic, and also the fact that I think the Fed do have a duty of care to the rest of the markets around the world, and they'll be conscious of the strength of the dollar and the effect it has on the emerging markets. But also from our point of view, it means that if they delay their rate rise, there's a good chance, even though Mr. Carney says that he will make his own decision, I think it will impact when the Fed go and when the Bank of England go. I mean, there has been some commentary that the Bank of England would raise rates before the Fed. I see that highly unlikely. And that's basically been quashed recently with Carney's comments at following the last MPC meeting. But yeah, the rate, the yield curve is important. But as I say, I think from a retail investor in a corporate market, its debt sustainability is probably more important than the volatility in the underlying government bond curve.
Absolutely, and we've spoken a little bit about inflation and how that can affect bond investors. We also hear a lot of talk about inflation expectations, and often they're being derived directly out of bonds, which are government bonds, index inflation-linked bonds. How does that affect the market?
That's really important, and that goes back to what I said before about when you look at interest rate risk, you have to split it into its component parts of where are real interest rates going and where are inflation expectations going. And let's go back to our favourite 10-year government bond, which gives us a yield of, let's call it roughly 2% at this moment in time. That 2% is comprised of a negative real yield of -1%, which means that you'll lose your purchasing power if you lend money to the UK government for the next 10 years, and an inflation expectation of 3%. So if inflation turns out to be more than 3%, you will be better off buying a UK index-linked bond, which protects you against inflation. But if inflation is below 3%, you would have been better off buying the nominal bond, the standard plain vanilla bond, as opposed to the index-linked bond. And those inflation expectations are really, really important when you come to assess on where you want to be on the yield curve, and also what sorts of credits that you want to be exposed to. We talked about the flattening of the curve recently. There seems to be a direct correlation at this moment in time between commodity prices and inflation expectations. Personally, I think that's potentially misplaced. Let's not forget the UK economy is 70% service-based. And so it's not the manufacturing economy that it once used to be, and therefore commodity prices, whilst important, are not the key barometer of where inflation is at this moment in time. And we are starting to see some wage inflation come through. You have things like the change in national living wage, minimum wage, etc. So wage inflation in a service-based economy is as important as commodity prices. And at this moment in time, I don't think people are paying enough attention to the wages, but they're paying too much attention to what's happening to commodities.
It should be said that there is a funny anomaly, though, in this break-even or inflation expectations. I think we call it the break-even inflation rate. So we look at the difference between, say, a 10-year conventional bond, government bond, and a 10-year index-linked bond, inflation-linked bond. And the difference between the yields typically tells you what the inflation expectation is over the next 10 years or 3 years or 30 years, depending on the bond you look at. For the UK, which is different to other countries, we look at the RPI rate rather than the CPI rate. And so when Kevin mentioned 3% just now, that's priced in a level of 3% retail price inflation. And of course, that's inflation measure that's recently rubbished by the Office for National Statistics. And people generally talk about a 1% wedge, 1% difference between the RPI and the CPI, which is the one I think the Bank of England's targeted with. So if we back that out, I think probably the bond market's saying, 2%, would you say, for the next 10 years?
The gap between RPI and CPI has typically been about 70 basis points, 0.7%. And the two reasons for that is RPI doesn't incorporate houses, whereas CPI, other way around, RPI incorporates house price rises, whereas CPI doesn't. And the other real difference is they just calculate it differently. So one uses an arithmetic average, one uses a geometric average, and that's unbelievably technical, but that alone accounts for about 0.5% on average.
Okay. Another area which has obviously received a lot of coverage over the years has been the situation in Europe, and particularly core Europe and peripheral Europe, and the spreads in their bond yields. I just wondered if you could explain what commentators are talking about when they're talking about these spreads, and if there are any conclusions that investors can draw.
I suppose so. And again, one of our favourite analogies is the nightclub analogy. So at the front of the line would be those genuine AAA rated nations, Germany, Finland, Netherlands to an extent. Typically they're less indebted, either on a net foreign asset basis or a debt to GDP ratio. So they have less debt, so therefore they have more affordability, they can pay their coupon. So they can issue bonds with a lower yield. So wonderful, we understand that, but that means investors get rewarded a bit less. The spread, what happened, we saw as the euro was incepted, some of those southern European nations were actually highly indebted, could issue bonds of a very similar price and yield to the core European countries. And then at various points, as we see the European crisis evolve and develop and then become to another crisis, those spreads have pinged out a bit. So Spanish yields went out to sort of 5 or 6% at certain points. Greece obviously went to 25 plus, and various other plethora of things. But typically speaking, we're saying that we saw the spread tighten in so that the peripheral countries could borrow at the cheap rates that the core countries could. Now that's widened out a little bit, and that's probably quite accurate. Obviously the core issue there is they're all using the same currency and they've all got the same interest rate obligations, which they can't get out of at this particular juncture.
Mm-hmm. From a market's point of view, I think the key thing that happened there was about 3 years ago when Draghi effectively said, I'm going to backstop all European governments. I think it's, I'll do whatever it takes to save the euro. And then the price or the coupons that had to be paid by these peripheral countries drops significantly. And so now people look at the spreads between the two. Typically, if you're worried that there's more risk, then the spreads get wider. And if you think there isn't much risk between the two, they become more narrow.
It got to a point, obviously, the tail end of last year where short-dated German debt was actually a negative yield. So you had to give them money to look after it.
And that's the equivalent of renting space in the Bundesbank vaults. You're that worried about your savings that you want to rent space in the Bundesbank vaults. It's madness.
Yeah. And just this issue on spreads, because obviously we've talked about it in terms of sovereign debt. But spreads are also important for investors when they're looking at corporate bonds, for example. Could you just talk around what these spreads are and how they affect the valuations.
Okay, so what is the spread when it relates to the corporate side of things? Everybody issues against a risk-free rate, and the risk-free rate in any market is typically given by the government bond rate. So in Europe, it's usually Germany. In the US, clearly it's the US Treasury. In the UK, it will be a UK government bond, a gilt. So let's say a company wants to issue for 10 years. We have the UK gilt that's priced at, say, 2%, and then we have to try and work out how much more we want to be paid to reward us for all those risks that we're going to take by investing in a corporate bond relative to a government bond. And let's say it's 3% to get us to a yield and a coupon of 5. Now, when it's issued at 5, but it could be the company that actually performs much better than people think, and people say, well, this is a much better bet. So the yield spread actually comes in. So say it goes from 3% to 2%, and the price of the bond rises. And that can happen in the opposite way. So typically, as bond investors, we like to see the credit spread tighten, and we don't like to see it widen. And what happens, and that can happen based on the individual performance of the company and also market sentiment as well.
Okay, and that wraps up our section on market commentary. Thanks again to panel for your views and comments.